The banks serve as the backbone of the entire financial system.
Failure of Silicon Valley Bank, the backbone of the tech industry.
When a bank fails, thousands of depositors and investors lose millions of dollars. During the 2008 financial crises, the biggest bank failure occurred with the closure of Washington Mutual, which had $307 billion in assets. Bondholders, stakeholders, and bank investors paid the most significant losses. Bondholders lost roughly $30 billion in investment, and others lost everything. To understand why banks fail, we need to understand how they really work. Banks act as intermediaries between people who have funds, which acts as deposits and lends them to those who need funds, which acts as borrowers. Example: if a person deposits $100 and the bank pay him 5% interest annually, and at the same time the bank lends $100 to another person for 11% interest annually, that difference of interest is where the bank usually makes money. But nowadays, banks have got various other ways to make money, as in capital market income, where the banks provide services like underwriting, merger and acquisitions advisory, and sales and trading services. Now, let's understand why banks fail with an example of the fall of Silicon Valley Bank in USA. During the pandemic, the deposits of the Silicon Valley Bank tripled. It was a huge influx, and they did what banks do. They took some of the deposits and made loans, but they also invested a lot of them in securities which were safe. Issues started happening when the Federal Reserve started raising rates, and when rates rose, the bonds fell in value. It isn't a big problem unless you want to sell those bonds, but the deposits started leaving the bank faster than they anticipated, and they had to sell their bonds and take a very big loss. The bank then made an announcement that it needed to raise capital, and were planning to do that. The next day, the investor completely freaked out, sold off the stock.
Many called it the backbone of Silicon Valley.
And then a bank round started where people tried to withdraw $42 billion in deposits just in that one day. This resulted in the collapse of the Silicon Valley Bank. Hence, banks generally fail when they become insolvent, which means they don't have enough funds to cover total customer deposits and whatever money they owe to others.